Okay, great. So today we're talking about valuations and about discounted cash flows in particular. And I've got Brett Dixon with me here, who is the Director of Valuations and at Bennett Thrasher. And I've had a couple of Bennett Thrashers with me here on the show, so this is great. They're a public accounting and transaction firm. And Brett here holds an MBA from Florida University, and he has spent a lot of years performing valuation work. So I'm really excited to have this chat with you. Thank you for joining me, Brett.
Absolutely. Thanks for having me and glad to be here.
Yeah, absolutely. Lovely. Okay. Maybe we could start off with a short intro about DCF and discounted cash flows.
Absolutely. So there are three commonly applied approaches that are often used to value businesses, that being the income approach, the market approach, and the cost approach. And the DCF, or discounted cash flow method, is a method under the income approach whereby projected cash flows over a finite period, including a terminal value, are discounted back to present value using a discount rate commensurate with the riskiness of achieving those cash flows. The terminal period value represents the value of the business beyond the discrete forecast period and can be estimated using varying methods, including the Gordon growth methodology, whereby the cash flows in the last year of the discrete forecast period are capitalized into perpetuity using an appropriate discount rate and long-term growth rate. An H model, whereby cash flows in the last year of the forecast period are grown at a higher growth rate for a short period of time, and then grown by a lower long-term growth rate into perpetuity, or even an exit multiple of a financial metric, whether that be revenue or EBITDA, based on multiples derived from either guideline transactions or public companies that are similar to that of the subject business. So more often than not, DCFs are typically performed on a debt-free excess cash-free basis, meaning that the interest and principal payments on debt, as well as any excess cash, meaning cash that is not needed to run the day-to-day operations of the business, are not included in the projected cash flows, producing what is referred to as the BEV, or business enterprise value of a company. And then in order to get down to the value of the equity of the business, other adjustments need to be made, including any excess cash, any non-operating assets or liabilities such as excess or deficit working capital, any investments that may be on the balance sheet, contingent liabilities, as well as reducing the BEV by any interest-bearing debt.
Yeah, thank you for that. That's actually a very good segue into variations between different models. And different there are different models using different types of formula, like the Gordon growth method and other ones that you mentioned. But also different professionals and all different agencies and firms will also have their own different approaches. So when it comes to formulas and inputs, what are the variations that you see in terms of DCFs or discounted cash flows?
Sure. So some of the common variations that we often see in DCF analyses, again, as discussed previously, using debt-free versus equity cash flows, in which interest and principal payments on debt are factored in. However, theoretically, whether or not you use debt-free cash flows and then subtract out debt from the resulting business enterprise value, or if you use equity cash flows to directly value the equity of the business, you should get around to about the same answer. Another variation we often see is using mid-period discounting, which assumes that cash flows are received evenly throughout the year, versus end-of-year discounting, which assumes that all cash flows are received at the end of the year, which may not be a reasonable assumption to make. Another variation we see is using differing methodologies with regard to estimating the cost of equity in the WACC, or weighted average cost of capital calculation, such as the build-up method versus the CAPM, or the capital asset pricing model. The build-up method uses an industry premium, whereas the CAPM uses a beta, or applies a beta, which is a measure of volatility or systematic risk of a company compared to the market as a whole, to the market risk premium. But again, theoretically, regardless of what methodology you use, you should get back to around the same answer. And finally, another variation we typically see is using market or industry-based inputs in estimating future cash flows or discount rates, which would produce an indication of fair market value, versus investor-specific inputs, which would produce an indication of investment value. So fair market value is defined as the price at which property would change hands between a hypothetical willing and able buyer and seller, acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or to sell and when both have reasonable knowledge of relevant facts. Whereas investment value is the value to a particular investor based on individual investment requirements and expectations. So whether or not you are able to identify a specific buyer for your business, for example, a private equity firm or a competitor, can help inform the decision as to the appropriate inputs to utilize in your DCF analysis.
Yeah, absolutely. And I think something across everything that you said here is the assumptions that go into that model. They are so important because they have they have an impact on the actual result that comes out from the model. And that's where scenario planning also comes into play, right? Looking at, okay, if we make this assumption, then this is the result that we come out with. And if we change that slightly based on a different scenario that could happen in the future, the results also may change.
Absolutely.
Yeah. And I think another thing so if we look at this from a business owner perspective, a business owner that's looking to prepare for an exit, then when would you say it's appropriate and valuable to use the DCF model? And also maybe touch a little bit on the type of businesses and industries where it's more valuable.
Absolutely. So operating high growth, going concern businesses in all industries can use the DCF method to value their business. I've valued everything from pre-revenue, small startup businesses in the technology industry, all the way up to large multi-million-dollar companies in the manufacturing space that have been around for 20 plus years to utilize the DCF method. So really, any and all sizes, any and all industries can utilize the DCF method in terms of getting their arms around what the value of their business may be.
Okay. In that case, what would you say the pitfalls are with the DCF? Because if you have a 20-year company with very stable income, for example, the risk of fluctuations or volatility may be different from a startup, right? Where you don't really know what the income will look like and what the growth will be, etc. And maybe just talk about pitfalls in general.
Yeah, absolutely. So some common pitfalls or things that we tend to watch out for with regard to DCF valuations are matching up the correct discount rates, or for example, the WACC or the cost of equity with the correct cash flows. For example, the debt-free cash flows or equity cash flows. Identifying any non-recurring or one-off expense items, as well as any non-operating or off-balance sheet assets and liabilities that would need to be included in the analysis. Identifying any revenue or expense synergies that a buyer may be willing to share with you via an increase in price. So obviously this will vary depending on the type of buyer we're talking about here. So whether it's a strategic buyer in which a potential buyer of your business may be willing to share some of the synergies with you, or a financial buyer in which there are often little to no synergies to be garnered. Using book versus tax depreciation and amortization, which is often much more accelerated. So obviously book depreciation is kind of merely an accounting exercise, whereas tax depreciation can have a real impact on the bottom line. Making sure your depreciation and capital expenditure forecast in the last year of the discrete forecast period or the terminal period offset each other. And if not, making sure that you're capturing any additional value related to the tax benefit of depreciation and amortization beyond that discrete forecast period. Another consideration is the structure of the deal. So considering the potential structure of the deal from a tax perspective, whether that be a stock deal or an asset deal, and how that might affect value. So just by way of example, in a stock deal, the buyer gets to utilize any pre-deal NOLs or net operating losses, subject to certain limitations. Whereas in asset deals, the buyer gets to step up in the basis of the tax basis of the assets acquired, which may increase the tax benefits associated with depreciation and amortization. So just making sure that you're including the structure of the deal in your analysis as well. Using reasonable long-term growth rates or exit multiples that are supported by economic and industry and or transactionally based information. Making sure that all the risks of the company are either baked into the discount rate you're utilizing to present value the cash flows, or baked into the cash flows themselves, and not both, in order to avoid double counting. And finally, once you've come to a value indication utilizing the DCF, making sure that any multiples implied by that value are not wildly inconsistent with what you're seeing in the market in terms of guideline transactions in public companies.
Yeah, great. Yeah, I think that's some really good points with depreciation, for example, because that, depending on which depreciation method you use, that will have a big impact. And also the tax with the transaction structures, asset versus a share sale will also impact that greatly.
Absolutely.
Yeah, absolutely. And if we jump on to the last question here, it would be very interesting to hear your take on the impact on valuation when you look at different time horizons. Generally, when you look at DCF, you tend to look at a bit longer, like 5, 7, 10 years out. But there are also cases where you use 3 years out. What are the impacts of that, just broadly speaking?
Absolutely. So the key to determining the right time horizon over which to estimate the discrete period of cash flows is estimating the point in time at which the company will reach a quote unquote normalized state from both a growth and margin perspective. So that time horizon may be longer for higher growth startup companies and shorter for more stabilized, mature businesses. The normalized growth rate that we're typically talking about is somewhere around GDP or inflationary type growth, which can be hard to estimate, in the current economic environment. So just remember that any increases in cash flows due to inflation should at least be partially offset by any increases in the risk-free rate used to estimate the discount rate to be utilized in present valuing those cash flows, as government bond yields, which are used to estimate risk-free rates, often rise in inflationary environments.
Yeah, thank you. That's really good. I also actually wanted to highlight something that you said earlier that I think is really important to take away as a business owner, and that's how you think about risk in regards to evaluation, and making sure that you're not double counting the risk, so that it's either baked into the WACC, what you use as the discount rate,
right,
or into the actual cash flows. And that's something that's really important, and especially I think with different types of buyers that will have a larger impact. So with a financial buyer, for example, they're usually really, really good at this, and they will kind of see through this very quickly.
Sure.
As will any valuation professional. So yeah, that's a very good point. Thank you, Brett, for joining me. I think this is very insightful. If anyone would like to get in touch with you, how should they?
Absolutely. So my email address is Brett, BRETT, .Dixon, DIXON, at btcpa.net. And my phone number is 770-396-2200. That's the main line at Bennett Thrasher. My direct line is 770-790-6479.
Super, thank you. I'll make sure to put that in the notes as well, so no one has to write it down.
Absolutely.
Yeah, thank you so much for joining us, Brett.
Thank you, Lynn. Have a good day.